What have I told you since the first day you stepped into my office? There are three ways to make a living in this business. Be first, be smarter, or cheat. No, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
It's yet again another Saturday morning, although a bit later than usual, but I had a few things to take care of beforehand, early in the morning. So that's it. Now, welcome back for the usual weekly market recap at this point. And what week we've seen, quite an eventful week, I would say. Maybe not from a price action standpoint necessarily, but we got a few things coming out, right? You know, we got CPI, just to name one, all right? And then, of course, still the conflict in Iran, which is keeping investors awake at night because you don't know what's going to happen with oil. So, you know, a few things here and there. And then, of course, we just kicked off earnings season with, I guess this week was financials, so basically the major banks. So we will try to have a look at pretty much all of that as far as the time will allow. But let's start out with the economic calendar, right? So we've seen inflation coming up. It was a miss, right? If you see the month-over-month, it came in at negative 40 basis points, which again, I mean, it was expected to be, you know, negative a little bit, but, you know, it disappointed even more to the downside, I guess. So, you know, the surprise was more downside, more tame CPI print than what was expected, which, you know, was majorly due to energy coming down. We've seen what happened to oil, right? Especially throughout the month of June. It came all the way back down into what? Low 70s. So, you know, guess it's normal to see a little bit of disinflation, especially, you know, in gas, which is the primary derivative of oil, right? And that puts the year-over-year read at around 3.5. So again, even in this one, was expected at 3.8. So again, was a miss. So, you know, as for now, yeah, I mean, we went up throughout this oil panic because of the war in the Middle East. Now, the thing is it a peak, right? Or is just a pause because, you know, as you well know, the conflict just restarted in full force. And it may be that we're going to see the Strait of Hormuz completely shut down in the coming weeks. And then again, that poses the question, well, what about the oil flows now? And what about, you know, all those strategic petroleum reserves, which are now particularly drained after the first wave of, you know, usage, right? So, you know, situation is a little bit in limbo there, but there may be another component which could offset the entire effect, which should theoretically send inflation, oil prices skyrocketing to the upside, right? Other than that, I'm not skipping it. I'm just postponing it for when we have seen through all of the data, all right? Core inflation rate month-over-month was 0. So no core inflation. So when you strip out food and energy, the so-called volatile components, there was basically no inflation, at least, you know, as measured by these metrics. I know that most people would call CPI the CPI because it's not really a good measurement of inflation. I get it. Also because I think the debate comes out of the fact that inflation is very subjective. Like inflation for me, it's not the same as it could be for you in terms of perception and in terms of practical consequences. It goes, you know, by many different factors. Like it depends on what you do consume the most. If you travel a lot, if you're young, if you're old, it depends on your income, right? I mean, if I'm making 100K a year, seeing inflation going from 3% up to 9%, it may impact me a lot, all right? But if I'm making $1 million or 2 million or 5 million, so who knows? Yeah, I mean, I'm going to pay a bit more, but who cares? I'm still a millionaire, so I'm not going to cry and bitch about it. So again, it's very subjective, all right? But the month-over-month, as for the core, was flat, which, you know, year-over-year then, it's still around 2.6. And look, since basically the last November, so fourth quarter of 2025, it never went up above 3%. Yeah, we had this peak, obviously, in April and May, but as for the rest, it stayed around 2.6, 2.5, kind of like that, which it makes you think a little bit, because, I mean, if you accept the fact that energy is the economy, right? I think we are all set up with that. I mean, if you have an increase in the price of energy, everything down the chain should go up eventually, because it costs you more money to acquire the energy, and it costs you more money for your raw materials, your input in your production process or industrial process. It costs you more money for maintenance, insurance, whatever, and then it costs you more money to move those finished goods from point A to point B. All right. So again, at a point, even on the shelf at the mall, you should see prices going up, because they need to reflect the increases, throughout the supply chain. But then why we never seen a real acceleration in the core, right? If not these two prints right here, although oil went up like what, 60% in Q1, basically from March and up until last month. Yeah, there is obviously a little bit of a lag in the transmission mechanism down the supply chain, but I do also think at a point that, and now that's where the link lies, the offsetting factor, if you want. At a point, I think you need to start to consider demand destruction. Because, if you are a producer, right, you can say, well, inputs are more expensive now, energy is more expensive, transportation is more expensive. I need to raise my prices in order to maintain my profit margins, obviously. But then you look at the other side of the fence, the consumers, so your buyers, and they're saying, you know what, no mas. We are pulling out. We are not going to accept. We are not going to bid these prices because whatever. It could be psychological. It could be we are tapped out. Most likely, if you remember the previous videos and when we were looking at, NFP average hourly earnings, average, salaries and whatnot, mostly it's because our wages are not keeping up with the pace of inflation. So at a point, we will need to stop. Unwillingly, maybe, but we will need to stop bidding. And so, there is only a certain point price can go up to. Yeah, up until the point you have demand sustaining it. If you don't have demand anymore, again, willingly or unwillingly, those prices will stop to go up. So it could be a little bit of that component in here, which would explain why, oil could go up, sure. Inflationary in the short term, up until the point you break the backs of consumers. And then again, at that point, it cannot be inflationary anymore, right? So and then you would need to add on top of it what we are seeing in the credit markets and what point do you think we're at in the credit cycle? But that's a whole different topic, all right? So let's keep going. We got, of course, talking about producers, we got PPI, which again, even in this one, right, as you can see here, it was a relatively high print, right? If you look at the data series, right? But was it, again, an acceleration compared to the previous print? No, it slowed down a little bit. So same logic applies. It is just a pause, or is it a peak, right? Core PPE, or PPI, sorry, they came in, well, they've been staying flat since April. And again, you could start to apply the same thought experiment we were talking about for the core inflation, all right? So again, because, you think about producers, right? And then you think about consumers, but you need to realize that those producers, they are the consumers of someone else. Like, they are the ones which are selling or producing stuff to sell out to you, the consumer, but they themselves, they need to buy those inputs or raw materials from someone else. So for someone else, they are the buyers, the consumers of those raw inputs. So you could apply the same logic, I guess. And at the end of the day, I mean, again, my stance is still the same. I think, as I said, for basically the last 2-3 months at this point, since when we got that problem in the Middle East, inflation driven by energy spikes, in my view, it's temporary in nature, right? If you don't have all the right circumstances, right, it's just temporary. In order to sustain that, you would need to have a very strong economy, which would be able to not only absorb the shock, but keep on growing and keep on doing what? Granting the workers in the labor market wages which are going higher and higher and higher. At that point, you may create that mechanism, which is often referred to as the inflationary spiral, where you have prices going up, wages going up, so they are capable of keeping up the pace and beating prices even higher. So prices go even higher and wages keep on climbing and trailing just behind them. But I don't think we are in that dynamic now. So again, I think at the end of the day, yeah, the Fed may talk about rate hikes and whatnot. I mean, they could, but I don't see the opportunity for that, because I don't see the scenario where we are all of a sudden catapulted back into the 1970s. All right. So that would be it for the inflation report, if you wish. We also have retail sales, which came in at not 0.2, so 0.2 month over month, which in and of itself, it's not a huge number, all things considered. But, this time around, that same phenomenon of adjusting it for inflation may work in reverse. Like, it was a low number, but, inflation was negative. So you could also say, contrary to the past, that this time around, people actually paid, the same, let's put it this way, to get a bit more, right? What was the headline? Month over month, -4. So if retail sales is +2, it means prices went down, overall, sure, they went down. And if prices are going down, and I'm still seeing a positive number here, it means that I spent kind of the same of last month, but I was able to buy a bit more, right? So it's basically the reverse of what we usually observed in the past, when this number was looking particularly good, and then you were looking at the rate of inflation month over month for the same month, and it was higher. So basically, at that point, that meant that you were paying more to get less. This time, you may say, well, maybe you paid the same to get more, or you pay less to get more. Who knows, right? Maybe it's going to be temporary, because usually we are not used to see it. But, just for a change, this time the dynamic may be described the opposite. Then what? Again, the consumer sentiment from the University of Michigan. It went up, sure. I mean, it rebounded. It was at historic lows. So at a point, you can go low for so much that, you're going to need to ebb and flow at a point. And again, it could be due to the fact that, we have seen prices, especially at the pump, going down a bit. And maybe that put a little bit more hope in the hearts and souls of the consumers which were responding to the survey. But again, as we've seen, there is a lot of political bias, especially in the Michigan Consumer Sentiment Survey. So maybe looking at the household survey would be a much, a little bit more of a genuine read. Who knows? I don't have it right here at hand, but I mean, if you want, just go check it out on your own. The break-evens for the 10-year, the 5-year, and the 5-year forward, what did they do? After a tiny bounce last week, let's zoom in a bit. It basically, I think, they came back down a little bit, and then they bounced just a tiny bit at the end of the week. So you could call them flat, but to me, the big signal keep on being this huge drop that we've seen, and up until the point you don't see a reacceleration in these ones. It's basically the market telling you that they don't feel to hedge inflation risks, right? Again, doesn't mean 100% there's not going to be inflation in the future. It only means that market participants, for now, they're not reflecting willingness or needs or intentions to hedge themselves against inflation risks, right? It's kind of like when you look at the yield curve. Just because you notice a flattener, a steepener, an inversion, doesn't mean that necessarily 100% we're going to see what the signal should look like. Well, no, but it just means that the market, for now, it's thinking that way. And usually, since the market eventually is always right, it's, that's sort of a signal that you need to pay attention to, right? At least to be aware, right? And not to be caught offside, right? Then what? Fed watch tool. Do you remember a month ago, the probability for a hike was almost 40%. Now we are down to 12, 13%. So again, I think especially with this CPI print and PPI print, hikes odds for July are basically, I would say they're gone. They're off the table because I don't think the Fed would like to disappoint markets' expectations at this point. No matter what Walsh tells you, he's not going to do that. All right. I think it would be interesting to see what the odds are for September, because of course in August they're not going to have a meeting. So next available data point will be in September. September, there are 50% odds for a hike, 25 basis points, right? I mean, who knows? It's too far down the road for me. I get the point of seeing the potential hikes because, the market is still probably signaling what the Fed is signaling, but, in 2 months, many different things could change. So, and again, at the end of the day, who knows? Maybe they will be hiking, maybe one time before year end, but is that tree-shed moment? I wouldn't. If I was them, I wouldn't. But again, I'm not them for a reason, probably. So, what's next? I was keeping it for later, but, just for the sake of it, a little bit of anticipation. The yield curve kind of steepened out this week, but in a very short term. So at the end of the day, you could still say we are in a flattening process, no matter the week by week fluctuations, all right? Because this week, obviously, you've seen a rebound in the yield curve. So it was flattening now. Looks like it's steepened up a bit this week, but I wouldn't read a lot in just a week by week comparison. I think, and this is why, in a nutshell, I'm not bringing that up every single week. It's most useful if you look at it month by month, probably, unless there is something really huge as for the news flow hitting the market, and then you may want to check it out. But other than that, I don't think there is a lot of usefulness in checking it every single day. All right. Then credit spreads, they're still very low, nothing to see here, right? So that would complete what we would like to highlight as for the economic calendar. And so we can just jump straight into the charts. As for the charts, what did we see? Well, the DXY, hell of a lot or nothing, still relatively sideways. We are, I think, at the end of the day, we are still trying to deal with this old area of resistance. So it's kind of the same as last week. Now, of course, if you remember, just a tiny little parenthesis, we highlighted this high right here, okay? And I think even this one as a very short-term high, right? And what was the premise? Like, are we breaking out, going for some sort of a rounded retest and then going higher? If yes, what you expect to see is these highs to be taken out. Now, we kind of trade about this one very briefly, but, this one right here was never approached. And then we immediately rejected back down and we came back lower still, though, if you think about the area right here, right? We are still in that same spot, which would, be categorized as a support and resistance flip area for now. So again, I guess we are still on as for the odds of further continuation up until the point you don't see, the structure completely being destroyed, in the sense that you would need to see these keep on bleeding back down. And then when you are basically, again, quote unquote, trapped in the old range, you may say, okay, that was a complete failure. It was just an attempt to go higher and it was immediately rejected. All right. So that would be it as for the DXY. Let's have a look instead at the other currencies, which again, they didn't do a lot. Like the only one which may be interesting would be the pound, which came back up a lot. I think it's because they had some, I mean, it is obviously a political event. They got a new prime minister, I think. So maybe it was that. They got a new government. We'll see. No pun with or toward my friends on the other side of the sea there, the narrow sea. But, back in the days, especially when I was growing up, everyone was talking about Italy being massively political unstable. The average duration of a government was like a year and a half. And, by the constitution, a government should stay in charge for 5 years in here. It looks like we are a bit more stable now, and the UK took that spot. How many governments did they have over the last 5 years alone? At least 3, I think. There was that one. There was that girl which lasted for what, less than a quarter, maybe 2 months. And the only thing she was able to do was basically sending the guilds market into a crisis. But yeah, I mean, again, I'm joking. I'm not. Obviously, there is no evil in what I'm saying, but it's just funny to remember. So, a bit more dynamic as for the price action, but the rest was kind of dull. The euro, not a lot. The yen, yeah, still weak, but it basically didn't move this week. So, Canadian dollar extended the bounds from this relevant area right in here. And I mean, can we really extend it back to the old relevant level in here? Or, I mean, we could also stop in here. I mean, even this level right here, this cluster, it's not bad. As you can see, we struggled to push through it in here. But when we pushed, we really accelerated down. Can we come back testing this area? So either it's, 139,800 or a bit above it, 139, even 139,400. But I think, if we reapproach this area, we might face a bit of resistance now, right? As for the rest, nothing interesting, to be quite honest. They're all doing the same. Indian rupee is still bullshit, kind of like the Japanese yen. And, the others are not really showing any type of new behavior. So I'm just going to cut them off very quickly here. Now, Bitcoin is interesting. Last week, if you remember, we were talking about both Bitcoin and gold showing a similar type of a pattern, if you wish, or behavior. The impression was one of two markets, right, both Bitcoin and gold, which were trying to find their footing. Now, the differentiation was that Bitcoin, even last week, if you remember, it closed Friday in here, right? While gold closed last Friday, where in here, right? So the divergence, so to speak, is that Bitcoin was much closer to the recent highs, right? A swing high, right? And gold wasn't. And apparently, that made a bit of a difference because Bitcoin extended that, grind higher while gold kept on grinding lower. So, sometimes even the tiny little details can make a difference. Now, of course, Bitcoin was going down, as you can see in here, at the beginning of the week. And then we got the CPI print on a Tuesday, and immediately it went up. And I think that's, again, when people were talking, way lesser these days, but in the past, they were calling Bitcoin digital gold. I never thought it was. Maybe it's a commodity, maybe, sure, but It's not gold at all. And it's not moving like gold if you think about it. Like, look, CPI goes down, basically. We have a disinflationary print, if not month-over-month, actual deflation, all right? And you see, obviously, Bitcoin, which is a risk-on asset, going up, right? But gold, it keeps on being weak. Why? Well, obviously, if inflation is going down, you don't feel the need of that safe haven asset. And again, even there, is it gold a real inflation hedge? Nah, don't think so. I mean, over decades, sure, but over decades, you could argue everything else may be, even stocks, especially stocks. So, look, this environment is full of narratives. Like the one about gold being a safe haven asset or most likely an inflation hedge, absolutely not. Right? For me, absolutely not. And the charts show that time and time again. Look, even this time, go back to, look, this is February, right? The end of February, beginning of March, which started what? The war in the Middle East and oil spiking up 60%. And what gold does on the back of geopolitical risk and potentially inflation down the road because of energy prices going up, it goes from 5,350 down to 4,000. Good job for being an inflation hedge and a safe haven asset in times of turmoils, all right? So again, is it always going to work like that? Obviously not. What I'm saying is that forget the narrative. There are many other different things which could move markets around, mainly liquidity, all right? So, again, forget the narrative, forget what you read in Vistopedia. It's not like that at all. Like, really, forget it. So, what are we going to see now? Well, I think, again, still same premise. Bitcoin may extend the bounce a bit more. Didn't take out this relevant high in here yet, but we came closer. The rejection for now, it doesn't look so strong. And, even Friday's close, it's a little bit of a dodgy, yeah, sure, but it's a long-legged dodgy with a shadow to the downside. So, in the morning it was particularly down, and then throughout the afternoon and the evening, it came all the way back up and it closed green. So you might call it a buy the dip attempt, I guess. We'll see. I don't like to judge it on weekends, but, it looks a bit more positive. Same stuff. I mean, where do you call it kind of defeated as for this grinding up behavior? Well, obviously, if we can maybe fail this bounce, creating a lower high and then cracking the lows, or the short-term low of this range, tiny little range, at that point, okay, the upside thesis may be completely invalidated. But you would need, again, a lower high first, and then potentially seeing going down, right? Instead, as for gold, it's a very tough decision in here. I mean, not that you have to make one necessarily, but let's call it a very tough spot. Because at the end of the day, we are still maintaining the 4,000 level, right? It's a big psychological number. At the same time, we have a little bit of a gap risk below it. It's not huge, like from current prices would be maybe a $200 type of slip if we really start to dump from here. But again, it's moving down. And as I said last week, look, even if you expect it to be lower over the coming weeks, unless there is some sort of a liquidity event, a liquidity crisis, like, don't expect it to go all in one blow, as it did, for instance, in here. I would expect a bit more of the same if it keeps on drifting lower, all right? Then again, if you see it maintaining the 4,000 level, keep on going sideways, and maybe at a point starting to, break some highs, right? It could be a sign of improvement if you're looking at it on, from the bullish perspective. But, for now, I don't like it. I wouldn't be interested in either directions, right? It's still a chop fest. So, yeah, no. Intraday, if you're trading the 1 minute, the 5 minutes, yeah, there are a lot of things to be done. But if you are trading the 4 hour and above, I would just leave it, all right? The other metals, they are all kind of down this week. Maybe platinum, it's relatively flat, but I guess the weekly candle should look like a rejection in here. That's it came all the way back up and it was rejected and it closed negative for the week. Silver kept on bleeding down. Palladium stayed relatively stable, and copper again. See that at the end of the day, you remember we got these anticipated resistance at the previous point of release. Tapped into it. Sure, initial rejection for now, but I mean, still higher lows, and now you get high relative to this one. So not bad. Again, structurally it's good. Fundamentally, up until the point is AI build out capex or whatever keeps on holding. Yeah, I mean, I would keep on being relatively bullish on copper, right? Then again, we'll see about especially the AI build out and the capex expanding. That's another different risk. But for now, up until the point it's there, okay, it's fine. All right. Then what? Then we got oil, which, just give it a bit more time. And, do you remember we were expecting the bounce? Or at the very least, we got what we were looking for in terms of the huge spike, a little bit of a consolidation, and then the huge drop, gap filled. And last week we were looking at this level, which was, of course, traded into. We forgot to highlight this one. We talked about the fractal nature of this tiny little segment of price action relative to these. This week, instead, I was expecting a little bit more sideways, to be quite honest, if you remember last week. But no, starting out on Monday, it immediately went up, which, at the end of the day, it confirmed, right, the scenario of 3 weeks ago when we were still down here, when we're talking about maybe retesting this level or maybe retesting this level. It did way more than that because we came up to this level right here, which is kind of relevant, right? And now we are holding above it. 1, 2, 3 retests, and we are keep on holding it. Now it's true, we may just fill this gap and then we'll see, but it's very headline driven at the end of the day. We are coming off a week where basically the US conducted strikes on Iran all week long. And they started with military objectives and targets, and now they're moving onto infrastructure. Like we've seen bridges going bye-bye. So, some may say the gloves are off, but, And next we are talking about power plants. So at least, not only with the talks, but now with the facts, we are seeing real escalation. So naturally, oil, it's reflecting that, at least from the geopolitical risk standpoint. Still, again, I would exercise a little bit of caution in here because I still think that you need someone to beat it up. All right. It cannot just be speculators in the futures pit. Fundamentally at a point, you would need someone to buy spot. And again, you may say, well, but dude, don't you know oil has the most inelastic supply of everything else on Earth? Because without oil, without energy, you can't have a civilization. I know it. I just think if you have a global economic downturn, what do you think is going to happen to the demand for oil? If you check the data for Chinese oil imports, they collapsed. All right. But again, another one may say, yeah, sure, they collapsed. But at the end of the day, if you then check another region of the world, which would be Russia, in the last quarter, Russia basically lost 40% of its refinery capacities because of what? Because of all those drones and missiles which are hitting Russia from Ukraine. So net, you may say, well, yeah, someone is buying less, but someone it's seeing supply constraints. So, and then you have the geopolitical risk. So all in all, it's normal to see price going higher. Okay, sure. Which is why they are going higher, I guess. But is it sustainable? I keep on thinking it's not, especially because I was checking this one. I was checking where did I put that? The CME quotes. I think it should be this one. Yeah. Now, so you got all the different contracts at different expirations. And what do you see? What meets the eye first? Obviously, the upfront month contract, it went up, for sure. But when you look at the degree at which every single contract went up, and you see that the nominal price, right? What you see is that prices are higher for August, September, and then what? And you see October, $2 lower. November, almost $4 lower to the upfront contract right now. And you see it goes on and on and on, and it's always lower and lower. So basically the curve, it's telling you, the futures curve, it's telling you that, yeah, there may be a lot of demand now, or, the other side of the equation would be supply, a lot less supply now. But in the future, again, either two things, either demand will go down or supply will be back online. I think, I would approach the dynamic from the standpoint of demand. Like, I mean, you can constrain supply, but what if demand falls more than supply, right? It's the same argument I always use with Bitcoin. Yeah, I mean, the supply is finite, right? And it's going down because every single month or year, there are less Bitcoins to be mined and added to the global supply. Sure. So supply is limited. Actually, supply or the expansion of supply is shrinking. And yet you see the asset going down 80% at times. Doesn't it tell you that there are periods where demand can fall and fall way faster than supply? Sure. So, that's what the futures are telling you for now. Can they change? Obviously, yeah, they can change. But for now, they're telling that there is much more convenience in, if you have oil sitting there, sell it out now. Because if you wait for 3, 4, 5 months, you risk to sell it at lower prices compared to now. So again, that would be it for oil, I guess. Very difficult market in my view. Again, especially if you consider what's going on around the world. But at a point you need to rely on something, and I would rather rely on market-generated information rather than what I can listen to on CNBC, Fox News, or whatever. So, that's just my way of doing things at the end of the day. Okay. As for the rest, we got yields. We spoiled it a little bit because I accidentally clicked on the yield curve tab. But this week, we've seen a bounce attempt in the treasuries, especially in the long bond and the T-note. And of course, since we have seen some sort of a steepening, the 2-year note, I mean, it bounced, but then it was faded a bit more than the rest. And look at the structure. This one, it's making lower lows. This one, equal lows, and this one, higher lows. So there is a divergence in there, which is why you see the curve, as for the yield curve, changing shape. At a point, it looks like, again, I get back to my previous talks. If you keep on looking at it every single day, probably it's not going to help you. But if you look at, I don't know, once, twice a month, it may be a much more indicative signal. All right. Because there are a lot of ebbs and flows. All right. So and even this market for now, it's very headline driven. Oil, war, the debt, the monetary policies, inflation or not inflation. So it's the economy growing. Yes, no. I mean, is it booming? It is slowing down. And what labor market is doing. So every single data point you get, it's going to be reflected in yields and bonds and treasuries moving along, because they're constantly trying to price in what each data set is adding to the big puzzle. So, sometimes it's better to zoom out, I would believe, right? And again, if you look at the yields, you see the exact same thing, but, obviously in reverse. So higher highs on the short end, lower highs in the medium end, and lower highs in the long end. So, is it the end of the world? Is it massively important? I mean, it's a signal in and of itself, right? But again, I don't think, for me, this is not a period where you should bet on massive inflation or massive disinflation in the very short term. I think things will probably stay relatively stable for probably another quarter, I would say. I don't expect things to change around a lot in the summer. Now, in the summer, I think it's a good place. It's a good period where you can build up a bit of weakness, but then it could be offset by what's going on or what will go on in the latest part of the year. But I don't like the summer that for taking long-term decisions, because I don't like summer trading. I think the market is a little bit more erratic throughout the summer months, especially again July and August. So I'm trying to be a bit more elastic in my reads on these ones, right? One thing I'm sure about anyway is that no matter what they tell you, and again, I'm reiterating the same old things, there is no demand for treasuries because the debt, because drunken, insolvent uncle Sam, yeah, sure. And then you look at foreign holdings of US treasuries, it's an uptrend which is still going on. People are buying more and more and more because of what? Again, I'm going to explain that just one more time, especially because it will kind of explain the difference in between foreign officials, right, and private official. If you're a foreigner, what's going to happen when energy goes up, energy is priced in dollar, you will need to liquidate your reserves, aka your treasuries, to get the dollars to buy oil or gas or energy at a much higher price denominated in dollars. So that might be why the reserves have been relatively flat. Not to mention, geopolitical risk, diversification, even in, on the reserve side of things. Not only US treasuries, we want to add a bit of gold. And we've seen central banks all over the globe bidding gold, sure. But then you think about private, right? A private, it's not necessarily your mom and pop. It could be private banks all over the globe, all right? Why do you think a bank would buy treasuries? Well, rates are going higher, so if I buy here, I'm capturing a much bigger yield. And you may say, yeah, but even inflation was higher, so that yield, it's nominal, but when you adjust it for inflation, it's a hell of a lot less. If not, on a 10-year or a 30-year bond, it could be negative, a negative return. It's going to be eroded by inflation over time. Yeah, sure, that logic would apply if I was buying that treasury with my own money. But I'm buying that treasury with my clients' money, the depositors. So I don't care. I'm still pocketing the spread. For me, it's still free money, which is why there is this kind of a glitch which generates infinite demand, which it's good for the banks, I guess. It's not good for the government because virtually nobody's keeping the government in check. Like, if that old legend about bonds vigilantes was true, at a point you would see every government, even the US, at a point that there would be someone, basically the market, telling you, you know what, you're going too far. We're not trusting you anymore. But since we have this perverse mechanism here, this glitch, these banks operating with your money, depositor money, for them it's still free money, so it creates an infinite bid. Now, sure, sometimes it could be a little bit higher, a little bit lower, but again, as you can see, no matter all the narratives, no matter all the things about the dollar is doomed, the deficit, the debt, M2 money supply is short, and still, this is where we are. So, just for the sake of it. All right. Now, brief pause, and then we will come back to wrap up the video with the stock market. As for the stock market, let's start out with the usual comparison in between ES mini futures and Nasdaq futures, so NQ. They basically started out the week the same, and they kept on behaving the same for the rest of the week. Started out selling off a bit, coming back up Tuesday, Wednesday, then usually you have what? Some sort of a reversal, and Thursday continuation down. Remember, Thursdays are usually very good days for either reversals or range expansion days. At least, in my experience. Again, doesn't have to be every single Thursday, but, if you have a very contracted beginning of the week, like your Monday, Tuesday, it might be that if the market is not getting out of the range initially, it will eventually. And Thursday are usually good days for that, right? Excluding some sort of a news-driven event or whatever. But, So if you zoom out a tiny bit, so if you go on the hourly time frame, what you see is that, we basically, if you look at NQ, broke below the previous weekly low in here, right? That was the previous week. That was the previous weekly low in here. We broke below it, tried to come back into it, retesting it, and we were rejected so far. Yes, kinda. I mean, it got the same behavior, but we didn't really took out the previous weekly low, which was put in on Wednesday. So again, relative strength, right? If you consider like these low and these higher low and these low and these lower low, right? So when you zoom out, what do you see? And again, look, the lines don't have to be precise. They're just there to highlight the different behaviors, right? But what you see is that the S&P is holding up relatively better, while instead the NASDAQ see all the lower highs and still pushing this sort of a, call it base, support, whatever. But they look basically the opposite one of the other. While instead, the Dow, if you do remember that ominous prediction, when you see a divergence in performances between the Dow and the NASDAQ, well, the Dow is still behaving well enough, same as the Russell. So what, just looking at price action alone, what you can infer is that the majority of the weakness is in what? Well, technology. Technology, and especially in the semiconductors, at least recently, all right? So again, the rest of the market, if you see the S&P staying relatively flat, again, you could say, okay, but, no matter what, but a lot of stocks which are in the NASDAQ, technology, like, your NVIDIA, Google, Apple, Microsoft, right? They make up a huge chunk of the index when it comes down to market capitalization, right? So how can it be that, the NASDAQ goes down and it's not dragging the S&P with it? Well, first of all, it's not like the S&P is making new highs, right? So there is a little bit of a drag already. I think it's much less pronounced because what? Well, again, you could only infer that the other stocks in the S&P, which are not tech-related, are probably holding up relatively better. So again, sometimes even by just looking at price action, you can infer this type of inner rotations in between different sectors of the market, all right? So you don't have to necessarily have a screener or, a sector analyzer. It's way better if you have, right? But the broad picture, you can just understand it by looking at the different indices alone and how they moved as for price action, all right? So as for this other layout, what you see now is that, SPY, again, kind of the same talks, it's still above that green moving average, while instead the NASDAQ actually closed below it this week. Now, again, reminder how to assess the break of a moving average, because many people get caught. It's not just the first open and close below it, right? You would need, ideally, a retest of it and see if you have a rejection. Because, sometimes it might be that the market trade below it slightly for a brief period of time, could be 1, 2, 3 days, and then it come back higher, right? Which is why they are averages at a point. If it is an average, it means that sooner or later, price will have to trade above and below it, right? In this case, I would say, beyond the disclaimer, it looks a little bit like a bad break in the sense that it came on Friday, like at the end of the week, a little bit of a volume spike relative to the rest, right? You see that volume candle goes above the average. And again, it's not really giving any signal of exhaustion, both on the RSI or the stochastic. As for the MACD, momentum is still down. So I would be cautious a little bit here, which is why we have been saying for weeks now, trim the winners. Do you remember when we were looking at that chart of SMH, semiconductor ETF? You know what? When something goes parabolic, it's not a bad time to at least take some profits and bringing it back to target weight, right? This is why, because then something like that can happen, right? Now, let's get out of the way the talks about earnings. We've seen financials releasing earnings. They were all beat, right? All good earnings, right? The only one thing would be, if you want to read a little bit in between the lines or have a look under the hood, is that although earnings were good, they kept on rising and growing. Like if you look at, for instance, JP Morgan, Goldman, right? They increased their revenues, and the most part of that increase came from where? The trading desks. So, people speculating, retail traders doing stuff. Then, of course, we have SpaceX IPOs, and it would be naive to think that these banks, which at the end of the day are acting as a dealer in the old IPO, right? They got a cut of the cake, right? But when you look at a bank like, I don't know, Wells Fargo maybe, which is a bit more lending oriented, so a little bit less Wall Street oriented, but a little bit more Main Street oriented. Well, the trading revenues, of course, wasn't that great. But, if you look at the revenues that they made off of interest, which when you think about that should be the core business of a bank. What a bank should do and how a bank should make money, it's basically collecting money from the depositors, paying them an interest, and then look for borrowers on the other side, right? Extend them loans and charging them a higher interest than what they are paying, to the deposit. And they should make money on that spread. That should be the core business of a bank. Or at least that was supposed to be. So when you see that the majority of the profits that these banks are now registering, it's coming off of the trading desks and not much from that lending activity, also because they're trying to tighten lending standards. Well, it basically tells you two things. Trading-wise, markets are particularly on fire. There is a lot of activity, which again, it's not necessarily a good thing, right? And secondly, it tells you that instead, the economy, which is supposedly fueled by credit, either it's not asking the same amount of credit, because maybe they know they can't. Like if your credit score goes down, you're not eligible for a loan, right? Or it's the banks which are not willing to take the risk in lending out into the real economy, which again should tell you something about the conditions, or at least, the assessment that these banks are making about the conditions of the real economy, So that would be a thing, right? So then, another big piece of news for the week, which is not here because it was scheduled for next week, I think. I don't know why they came out earlier. Yeah, it should have been next Wednesday. IBM. I mean, did you see what happened to IBM? Was this drop right here. Look at that. I mean, substantial, right? It dropped like what? 24%? I mean, from peak to trough, it was like what, 76? But yeah, it's still even 74. It's not, I mean, for one trading session, it's not a small loss. Yeah, in a nutshell, they basically said, you know what? Our revenues will be worse than expected. This quarter, quoting the CEO, I think he said, we faltered, right? Okay. But, the problem was the motivation. He kind of warned, so to speak, that a lot of clients, they were moving their spending priorities from software or consulting, which is basically the core business of IBM, to what? To hardware. So basically chips, memories, right? So this is why you keep on seeing stocks like, I don't know, SanDisk or the other Korean one, SK Hynix or whatever, or Samsung, or Micron, which is why you keep on seeing these companies actually, growing earnings at the expenses of these other companies, the software companies. In and of itself, that wouldn't be that big of a deal in the sense that, it's normal, right? If money flows are moving from one sector of the market to the next, overall earnings are just, growing a little bit more somewhere else and a little bit less where they used to grow. Problem may be if you really want to extend the thing, although, again, it's not a problem for tomorrow, I would believe. I mean, who financed these software companies like IBM? Or like we said in the past, ServiceNow or Adobe or Salesforce, right? A lot of that is private credit. And, there are a few rumors, there are a few talks, there are a few scares about private credit right now. And again, I said in the past, look, the magnitude of that, it's not huge. It's not even comparable to the financial crisis and the amount of notional value which was put on all those subprime mortgages. Sure, still, you don't. The risk is that you don't know what's in there. What is there in that fund? You don't know. There are kind of like black boxes. You don't know who they really lent the money out to, right? And therefore, you don't know the risk of potential contagion, right? Again, I don't think it's going to be a story for next week or next month. Hopefully, I still think it's a tail risk, which sooner or later it's going to come back and bite us in the ass, because it all comes down to the credit cycle at the end of the day, right? Back after 2008, right? All these banks, they took on so much risk, lending money to basically everyone in the subprime mortgages, exuberance or extravaganza. So after the crisis was, quote unquote, resolved, the policymakers, the regulators, they said, you know what, dear banks, you can't keep on doing that, right? You can't keep on lending money to whoever. Otherwise, you're going to repeat the same disaster. So what did they do? Well, they created these private credit funds and the BDC, like what? Like Blue Owl. So now the problem is, look, Mr. Regulator, I'm all cool as a bank. Look at my balance sheet. I don't have very risky credit, right? I just lent money to Blue Owl, which is an entity with a very high credit score, right? But, whispering then when the regulator is turning his back, let alone the fact that we know for a fact that then it's Blue Owl, which is extending loans to all these people we used to, but now we cannot. So we just add a layer in between us and the same fucks we were financing back then. So the problem is still the same. If the credit cycle ends, all those fucks are going to be insolvent because we extended loans to people which were not worthy of that. So the BDC are going to be in trouble, and we lent money to the BDCs. So at a point, even our balance sheet is going to be involved and hit. But hey, from a regulatory standpoint, we're cool, man. Nothing to see here. Move on, move along, right? That's basically the dynamic in there. But it's going to be a problem tomorrow, next week. Probably not, right? And even if it's going to be a problem, people may say, well, who cares? It's private credit. Like, your average Joe doesn't invest in private credit. It's all people who can afford to lose the money, which so basically higher income tier of society, which is fine, I guess. But when you look at the data and you see that 10% the higher 10% of the income brackets of population, it's basically propping up 50% of the American consumption. An economy which is based 70s or 68% on consumption. So if you're going to hit those 10%, which is making the majority of the spending, what do you think is going to happen to aggregate demand from the consumption standpoint? So, you know, it's easy to say it's not going to be a problem because those people can afford to lose the money, but then they lose the money and they say, you know what, I take a big hit here. I need to rein in my spending. You know, problem is we were those which were fueling up the majority of the spending in the economy because, you know, the lower side of the K, it's already tapped out. If we pull out too, aggregate demand will evaporate. So, you know, it's not much the magnitude of the, you know, the damage financially which could be made by these institutions having problems is the perception and then the behavioral change in aggregate demand because of the dynamics I just explained. So again, is it a problem now? Probably not. Is it a huge problem in and on its own? Probably not. Again, I mean, these people may be able to take the loss, and even the banks. I mean, if you are JP Morgan, like, again, even if you lose 10, 15, 20, 50 billions, are you going to go bust? No. But perception in the real economy may be different. So that may be why it could, again, be important in a undefined, distant future. Who knows? All right. So other these tiny little parentheses, let's have a look instead. Do you remember last week we were looking at these just for the sake of seeing that it's kind of happening, right? If you look at the ratio in between MAGs and momentum ETFs, it looks like we are having that little bit of a flip with, you know, the ratio getting back above the moving average. You see them looking at the single ETFs, the blue, so MAGs, keep on climbing higher, the yellow momentum keep on sliding lower. So there is this flipping, I guess. And, you know, obviously what you see though is that in black, let me zoom in a little bit right here, okay? So in black, you have the S&P, all right, which is holding up better than the NASDAQ, which is in red, all right? And you may ask, okay, what's the blue line? The blue line is the RSP, so the equal weighted index. So you're seeing a situation where the equal weighted index is performing better than the market capitalization based index and better than the NASDAQ. So again, you remember, getting back to this, you can see things even if you don't have a screener. Yeah, I mean, so even if you look at these, what you see is that there is a rotation and breadth is actually improving because the RSP is performing better than the market capitalization weighted index. Now, is it enough to keep, quote unquote, the entire house of cards up on its feet? So far, I guess it is. I would also add, though, that, you know, if we keep on seeing the tech sector, semiconductors underperforming, you would need a much wider breadth, much more improvement in the breadth, right? You would need the rest of the market to make more heavy lifting than what it's doing right now. But nonetheless, I guess it's still something that you can appreciate. And again, it's something that we're looking at it last week. And I mean, at the end of the day, it was kind of a good anticipation. I don't want to say a good call because at the end of the day, I mean, again, how do you define it a good call? Because is it a call to say MAGs will start to overperform next week or next month? I mean, maybe, but then what? Then you see that no matter what, they are still, leading to the NASDAQ going down and semiconductors. What about semiconductors for a minute? SMH going down. So it's a call in terms of relative strength, but is it really a call to pull money in? I don't know. Look at SMH, right? Semiconductors. Now again, you don't have to, to see a head and shoulder here, just, I guess, for the sake of a little bit of doom and gloom. But if this is a head and shoulder, right, a little bit of a double head, if you wish, but, the neckline, it's, I guess, well defined enough. Although maybe it should be a bit lower, maybe it should be a bit more like this. So this should come around a bit lower, I guess. But, nonetheless, it's still kind of the same. It probably should be a bit more like this. But, the very end of the day, who cares, right? So again, however you want to draw it, it's never going to be perfect. But if it is a head and shoulder, right? And you take the, the distance from the neckline up to the top of the head, and you project it from the break of the neckline down, ideally the target to the downside should be kind of in here. Which, if you take the Fibonacci range or retracement and you plot it on the last swing high from, the swing low in here to this massive run up, what you see is that it would be in line with the 618. So the golden ratio. Is it just fantasy? Are we just trying to project what we would like to see out of this into the future? So that, now you know what, it's going down, but look, I'm holding it because look, it's going to bounce right in here and then it's going to moon once again, right? Maybe, I don't know. I'm just saying there was before, and we were talking about it last month, and there is still a potential risk of further downside in the semiconductors, right? And then, you wonder why the QQQs are performing so, relatively weaker compared to the rest of the markets, all right? So that could be one thing, all right? Now, let's have a look at a few slides to be a bit more positive, I guess. Again, I'm not saying I'm full-on bearish. I'm just saying this market is getting a bit weaker than what it used to be. Nonetheless, we have seen record highs of global demand for US equities. So, foreign investors are still pouring money in the US equity market, no matter what, no matter the narrative, no matter the doom and gloom talks. That, again, if you notice, I've spent 20 minutes talking about stuff that should be considered bearish, right? Am I full on bearish overall when I zoom out and I look at the structure of the longer time frame? Not really. And again, I've been, calling from, I started in April, but I've been saying for months now that if we're going to have another 8-10% pullback, it's probably going to be in August, September. We are approaching those periods. We are now at July 18th. Does it have to be right at, the beginning of August? It could be a bit less, a bit ahead of that, a bit before that, but the period would be there to suggest a little bit of caution. And it looks like being cautious for now, it's a good position to be at, right? And so, nonetheless, people are still putting money in. Then what, even inside the US, I guess, retail cash equities, average daily net notional, which is a lot of nerdy words to say even retailers are still putting money in at a record pace, if you look at that, right? So not only foreigners, but, even inside the US, because this is basically from Citadel Securities. So, people are still trying to buy the dip, right? And then what? The concentration risk, sure, since we were talking about rotation, relative strength. If you look at that over time, what you see is that, I guess this stands for technology, media, and telecommunications, but it became a bigger and bigger slice of the huge market cap weighted index cake. Now, to some degree, I do also think it's normal because, technological progress and advances. I think it's natural that more and more companies which are going to be listed on the stock exchange will be dealing in technology. It's something to consider, but I do also think that it's kind of part of the course. If society, the world in general, it's getting more and more linked and entrenched with technology. All right. Then what we got, sentiment. I mean, if you look at the individual investor sentiment survey, I always forgot the acronym in here. I don't know. National Association of Individual Investors, I think, but nonetheless, they are still bullish. And if we check the managers, the fund managers, the money managers, they are bullish as well. So sentiment for now, it's not impacted. What is impacted, and we hinted at that last week, could be this. We already talked about this, right? The Atlanta Fed GDP bringing down estimates for GDP. Last time it was 1.6, now it was 1.3, but now we got these. So the components, the contributors, right? And obviously imports, they surged, and of course they are negative on the GDP calculation, obviously. Well, I mean, they surged because we still have this AI build out, and you need a lot of stuff that you need to buy abroad to then bring all those, base goods, raw materials and whatnot. It could even be like even chips, like TSMC, right? You are exporting stuff from there, or SAML in the Netherlands. You need that UV lithography if you want to build chips, right? So it could be a lot of that. But PCE recently it went down. Business fixed investment relatively stable for now. Government still stable. I think when you look at this, right, what's keeping these value relatively positive yet, although revised lower, it's what? Business fixed investment. I don't know about you. Again, might be a terminology difficulty for me since I'm not a native English speaker. But when I think about fixed investment, for me, it's very similar to AI build out. Like fixed investment, if you are building up an infrastructure, does it check all the boxes for that definition? I would think it does. So again, the risk may be, okay, what if we see a slowdown in these capex expanding? And again, it could be for many different reasons. It could be maybe because although, these companies, the hyperscalers, right, they have they generate a lot of revenue, so a lot of free cash flow. But we are also looking at it now and seeing that all these cash flows, instead of, being quote unquote free, no pun, it's immediately poured in the AI build out. There's not a lot of cash flow. It's if you are spending a lot of your own money to build out the infrastructure. And now that the cash flow is kind of diminishing or almost flattening, what you see them doing, well, initially going into the bond market, but interest rates are too high, and servicing the debt would be too expensive. So what do? They issue equity. So there is a problem with corporate treasuries. So basically, these companies going around and issuing bonds to finance themselves. Even Nvidia had a bit of issues trying to put out a few billions of corporate bonds. So naturally, they would prefer to issue what? Equity. You don't have the cost of servicing debt if you are issuing equities, right? Sure, you are diluting the investors, but who cares? I mean, they are still promised the huge returns in the future when this infrastructure is completely built out. All right. So I think what it's really propping up, long story short, what's really propping up GDP for now, it's still these AI built out. So if you see a slowdown in that because of whatever, interest rates are too high, we can't finance ourselves. We issue a few more shares, but now investors are not bidding it anymore because we already diluted them. So we have to slow down forcefully. that could be net, it could be a drag on overall GDP. Not to mention, potential scares about, well, just this week, I don't remember the name, but a company in China announced a new AI model, which supposedly it can perform slightly worse, but we are talking a few percentage points, slightly worse than the American ones, but it's much more cheaper. So again, even that one could be something which throws a branch in your wheels when it comes down to spending billions on this stuff. And then the returns will be where if people may prefer to buy something which is a bit less accurate, maybe 1 or 2% less accurate or fast or whatever, but it's 10x cheaper to build up and it's 10x more power efficient or power hungry. Not saying we are there. And again, we've been there with the DeepSeek moment last year, and then you've seen what happened to markets. After a week, it was completely forgotten and markets kept on going higher. But just for the future, right? Something to still you should keep in mind, because at the end of the day, AI, the form of creating agents, AI agents, it's just a commodity at the end of the day. And in a competitive environment, the only way you have to gain market share is to bring that price of that commodity down. And in this case, you could think about commodity in the sense of those tokens that you have to buy and then spend to get the answers or the computational power from the agents. If those tokens go down and down and down in prices because those companies will need to compete to attract more market shares, where the revenues are going to go? Where is the return on investment, right? So again, I think it's still up to debate, but there is something to be worried maybe. Maybe not tomorrow again, but who knows? Again, still talking about semiconductors. Are we seeing earnings peaking? Again, it depends on what your view is about this build-out. It's still going good? Would you need to reprice the risk of that slowing down a notch? Because, if it slows down, even the revenues for the semiconductors producers is going to go down. And if it goes down, what's going to happen to SMH? If revenues goes down, stocks need to be repriced for lower earnings, right? While the price is still relatively high, right? So, something to think about. And, well, I mean, better. So momentum, what we were looking at it a few minutes ago. Momentum dropped a little bit, but I guess most of it was driven by semiconductors taking a little bit of hit. But I guess at the end of the day, it's not something that would completely send the market down 20-30% in a matter of a quarter. So now I don't know how long the video is already, so maybe what I wanted to talk about a little. Now this time I'm not going to do it, because it's probably going to take another 50 minutes, so I'm not going to do it. But promise you, we are going to discuss a little bit about bubbles next time, so next week, right? I don't think even, if you think this is a bubble, right, that we are living in, I don't think it's going to pop from here to next week. So we may still be in time to take it as a relevant argument or topic of conversation next week, right? So for now, you know what, I'm going to cut the video here also because it starts to be a bit late in the morning, right? And don't forget, next week, from the economic calendar standpoint, it's probably going to be a dull week. Let me check just for the sake of it. IDP employment change, but who cares? Yeah, not a lot. Actually, nothing really important. Oh, well, I mean, PMI, but this is the global one. As for earnings, we are going to have something important. I think maybe Google, Tesla, there you go. Google and Tesla are there, and Intel. So, big names starting to report earnings. Could be a market mover. So, just pay attention to it. Both to what price is doing going into earnings, and then what the numbers are and what type of reaction you see from markets. All right? Could be a good tell. Not maybe for the day itself, but for the weeks ahead. All right? And with that, I'm going to leave you off. And I'm going to wish you a very good weekend. And as usual, be nice and be cool. Knees out.
Shit, this is really gonna affect people.
Yeah, it's gonna affect people like me.
Well, real people.
Jesus, Seth. Listen, if you really want to do this with your life, you have to believe you're necessary, and you are. People want to live like this in their cars and their big fucking houses they can't even pay for, then you're necessary. The only reason that they all get to continue living like kings is because we got our fingers on the scales in their favor. I take my hand off when then the whole world gets really fucking fair, really fucking quickly, and nobody actually wants that. They say they do, but they don't. They want what we have to give them, but they also want to, play innocent and pretend they have no idea where it came from. Well, that's more hypocrisy than I'm willing to swallow, so fuck. Fuck normal people. The funny thing is, tomorrow if all of this goes tits up, they're gonna crucify us for being too reckless. But if we're wrong, and everything gets back on track, well, then the same people are gonna laugh till they piss their pants because we're gonna look like the biggest pussies God ever let through the door.